Hi there. If you want to be a trader, one of the things you have to do is start thinking like a trader. Well, how do you do that? I'm champion trader Kevin Davey, and today I'm going to show you how to think like a trader. So for the first 10 years or so of my trading, I was doing a lot of things wrong. But one of the things I never fully grasped was how to think like a trader. And once I started doing that, my trading improved quite a bit. So what does that mean, thinking like a trader? I'm going to show you. So first, here's a question for you. Which of the following would you take? A system that wins 90% of the time? A system that wins 10% of the time? Or maybe you just don't have enough information and you don't know. What would you answer, A, B, or C? So here's another question. Would you want to trade a system that had a reward to risk of 3 to 1? A reward to risk of 1 to 3? Or do you just not know? What would you answer? And then here's a third question. Take a look at this equity curve. Would you trade it? Yes, no, or you don't know? Well, I'm going to give you explanations later, but if you answered C for all three of them, congratulations, you're already thinking like a trader. So what does thinking like a trader involve? Well, first, it means knowing which performance numbers to look at, which to ignore, how to combine them. Thinking like a trader also involves digging deeper into the statistics that you're looking at, and it helps give you confidence to trade better. And finally, thinking like a trader means looking at historical performance and knowing how to analyze it correctly and when to use it and when not to use it. So let's talk about statistics. Most people love winning percentage. The problem is it's useless by itself. Here's an example to show you just that. Just because you have a higher winning percentage doesn't mean it's a better strategy. In this case, the lower winning percentage strategy is actually the better one. Reward to risk is another number that a lot of people put all their attention on. And they say you got to have a good reward to risk ratio. Well, here's an example that shows the opposite could be the case. You could actually have a better system with a terrible reward to risk ratio. The point is, with both winning percentage and reward to risk, it does not tell you the whole story. You need a different performance metric, and that's expectancy. Expectancy will help you determine if a system is good or not, regardless of winning percentage or reward to risk. So use expectancy. That's what good traders do. So using the right numbers is one way to think like a trader. Another way to think like a trader is to use the historical performance wisely. A lot of people look at a backtest curve, an historical test curve, and they'll immediately make decisions about the strategy, how to trade it, how to position size, and a lot of other things with it. And that's just wrong. Why do I say that? Well, equity curves by themselves are just junk. Because you don't know how the strategy was developed. You don't know what went into it. You don't know if it was curve fit, over-optimized, or anything. And a lot of people out on the internet take advantage of that because they'll show you ads with these great looking equity curves. The problem is if you don't know how they were built, you're not going to be able to understand if it's a good strategy or not. So the key with understanding historical equity curves is knowing how the strategy was created. And if you want to think like a trader, next time you look at an equity curve, think about how it was created. And if you don't know how it was created, then you have to be a little more skeptical of the results. But if you build the system yourself, So for example, I use walk forward out of sample testing, so I know I can believe the equity curves. That's the key with looking at historical equity curves, is knowing the how of the development process. My simple rule here is I doubt every single equity curve I look at unless I personally developed it and I know all the steps that went into it. That's a good rule to live by. One final note with equity curves, don't fall in the trap of thinking the largest drawdown you see in an equity curve is going to be the largest drawdown you'll ever experience. The phrase, your drawdowns in the future are always going to be greater than your equity curve, is a good one to live by. Even if it never comes true, always expect bigger drawdowns than you see in your historical testing. That's how good traders think. So the final way a good trader thinks is by having a process of developing strategies. And part of that process is gaining confidence as you build more strategies. So you have ideas, you build strategies, you have good real-time results, and that reinforces that you're doing things right. And if you don't have good results, then you know you have to make some changes to the way you are developing strategies. So that kind of wraps it up. So what do good traders do, and what do they think? Well, first of all, they know what performance numbers to look at and which ones not to look at, and that helps them make better decisions. Second, they use the historical equity curve not as an absolute, but as a guideline for what they're doing. And third, they have a process to build strategies, and they know that process works and they have confidence in it because they've used it over and over again. So if you use those three keys, you will start thinking like a trader. Well, maybe you have some other ways to think like a trader. If so, leave a comment. If you like this video, give it a thumbs up, please. And don't forget to subscribe to my channel. I'm Davey, and thanks for watching.